I need some traction. You need some traction.
All right. Hey, everyone. Lloyd Lobo here, co-founder at Boast AI. Boast AI enables innovators to change the world by getting them access to billions of dollars in government tax credits and resources to become successful. Today's session is brought to you by Boast AI Launch Academy in partnership with Growth Blazers, Founder Institute, Lazaridis Institute, and BCF Ventures. As you're joining the session, feel free to introduce yourself to all panelists and attendees. Tell us what company you're from, where you're tuning in from. We've got almost 1,000 people or more signed up. This is going to be an exciting, fired up session here. And if you have any questions, type them in the Q&A tab because the chat gets super cluttered. I'll try to take them at the end or as we go along, depending. Awesome. So today's session is near and dear to me because it's one of my near and dear friends, Kris Hartvigsen, CEO of Dooley. I think we started our journeys probably around the same time. He's one of the hardest working people I know. He's one of the nicest people I know in tech. And he's been through a roller coaster in the last year, including raising 3 rounds between seed, Series A and B, 100+ million in a record 6 months. Kris, thank you for being a friend. Thank you for joining Traction. How are you today?
I'm good. How are you, Lloyd?
I'm doing well. You've had quite the roller coaster. 2021 is just bonkers for you and Dooley. And I always say great things happen to great people, and you're one of the greatest humans I know in the business, man. So introduce us to Dooley.
Yeah, we started this journey with Dooley a few years back with this idea of helping people stay in their high value mode. So we focus on sellers and basically anybody in the revenue team. And what you'll know if you're in the revenue team is that you have a world of responsibility to try to bring in business and to try to secure business that's already in the door for renewals, et cetera. But you also have all of these responsibilities to the team, which is like sending in your updates to Salesforce and sharing information around the business. And it just became this real big time sink for people. It's only getting worse because of the pandemic and the expanding tech stack. So Dooley is just a really simple workspace for people to connect their notes and their updates back to the rest of the business in a way that is incredibly seamless for the end user. Super high speed updates delivered back to the business without any friction.
Awesome. And Dooley is beyond a product, right? You say it's a movement. It's the connective tissue for global teams everywhere. Elaborate on this.
Yeah, so I think that we decided to take up a fight that's a little bit different from the norm in the enterprise space. So if you think about most enterprise software that is introduced into the business today, it's top down, it's pushed on the organization. So it's really easy to pick on Salesforce, but all CRM platforms are very similar. So we'll just say CRM is imposed upon the individual contributor, and they don't get a lot of say in that. And it doesn't really meet their needs. You never updated the competitor field in Salesforce, and magically, there was this white paper that was on your desk about how you could beat that competitor, or a battle card that was surfaced for you. So there's like this latency that happens. And so there's a lot of frustration around that. And so we started working with users and trying to understand their pains and their needs. And it became really clear that we weren't just helping them to solve like a small problem. We were helping them like recover their mental health. We were helping them recover their weekends. And we call it the Dooligan spirit. What we're trying to do is help people to become the best version of themselves at work by just creating space for them to do their best work. And we have people that do inordinate things for us. We have people that create videos and post them without any ask on our behalf. We have people that do all sorts of things to get the Dooley word out there to their peers and their colleagues, just because they realize that what we're really trying to do is liberate people from doing shitty work.
Definitely. You know what is, I'm just monitoring the chat here, and you got people from India to Lagos to Luxembourg to the United States and Canada. It's all over the place. This is awesome.
Cool. We're hiring in all those geographies, by the way, so feel free to drop me a resume.
Is it dooley.ai/careers?
Yeah, I believe that's what it is right now.
Awesome. Dooley is hiring, Boast AI is hiring, both of us are hiring. So hit us up. Geography doesn't matter anymore. So does this mean then that salespeople will just have to do less data entry right now and be able to sell more, or does it eventually get rid of the sales layer between the frontline and success teams?
So there's like, think about what Salesforce really is, right? It's a filing cabinet, and somebody threw this filing cabinet that we had from 25 years ago up into a cloud and said basically, keep updating the filing cabinet, keep putting stuff in the filing cabinet. And that's just one of many things. Like the tech stack is now expanding vertically for each part of the business. So I don't think of us as just this update layer. That's a nice thing. I think of it as an organization layer, like a system of action, somewhere where you can again focus on the work that needs to be done and also contextualize it, right? So what your manager needs from you is different from what you need from your manager, and what your product marketing team needs from you is very different again. So we want to be able to create texture with anything that we're sharing back to the rest of the business so that people can just do their job that much more efficiently. So is it just about updates? It's about organizational velocity. It's about making everybody faster, and making everybody more efficient and more in the know of the things they need to be in the know of.
And the way I see it is, there's this age old concept of sort of the rock star rep, right? And that exists because back in the day there was this institutional knowledge that sat within a few sales reps' heads that lived in their Excel sheets, and then came Salesforce, which I think is like an empty house CRM. Like basically, it's an
Yeah.
empty filing cabinet that you have to fill. So still, that institutional knowledge sits a lot in their heads. And what you're doing is you're basically democratizing that institutional knowledge and saying every rep can be your best sales rep. Every rep can be a rock star, and that is
Yeah.
so powerful, right? Because
Yeah.
that focuses, that removes the grunt work from their busy day, helps them not only close more deals faster, but saves them time to build stronger customer relationships, long lasting relationships. Now,
Yeah.
tying to today's topic, you've raised a Series A, seed, and B, but you took a while to get here, right?
Yeah.
And good things take time. I mean, I had talked to lots of founders, and good things do take time. But this brings the question of, at what point did you think we had product market fit? How did you get there?
Yeah. So I think of product market fit as something that's earned and then re-earned and then re-earned and then re-earned. It's like perpetual. You don't get to say we have product market fit done and away things go, except in very, very unique cases. And I would argue that even those probably have to continue reinventing themselves. So for us, we had product market fit. I would say in late 2017, we started to feel like the wind was hitting the sail at the right angle and the boat was starting to move. Um, and it was just this really simple concept that we had built out that was like the ability to distribute information back to Salesforce and make sure that all of the unique things were updated in a single click. That is sort of where we were in 2017, 2018. And again, I think of it as something you have to continually re-earn because the market continues to move. If the market was staying still, then it would be simple. You just be like, oh, product market fit done. Here we go. We'll just start collecting money. But we continually layer on new things to try to stay ahead of that curve of where people are and what their needs are in their business. Again, tech stack continues to bloat. You got more things that are competing for somebody's attention. You got a lot of context switching that's happening. How do you stay on top of that? That's a big job. So yeah, I would say like late 2017, initial product market fit. I think that we ended up with, I would say, another layer of that onion around the time that the pandemic really kicked into high gear. So you think about like what happened to most sales organizations in February, March of last year. Budgets started getting slashed by all of their customers, their prospective customers. So like sales, the e-brakes got hit real hard. And then we all realized that we could continue to sell, but we needed to revise the way in which we operated. And so like I would say around May or June of last year, we started to just see this crazy spike in users. And the only thing you can attribute it to is people were working from home, bosses needed better visibility into pipeline, but reps are going, yeah, but I'm now needing to manage twice of the volume of deals in order to hit my number. I don't have time to give you that information anymore. But I found this thing called Dooley. You sign up for it, I'll sign up for it, and then we'll be able to keep on top of each other's needs quite easily without the burden. Next layer of product market fit. away we go.
And were there any specific signals that you said, man, I got product market fit? Was it that you got maybe 10 unaffiliated customers that loved the product and just, I was seeing a lot of buzz around you, like a specific, like what were the indicators I get that made you feel I got product market fit?
We look at a couple different things. So one is just like active users and what percentage of people are active, meaning that the people that are signing up are pretty engaged on a pretty regular basis. So we wanted to see a weekly active user number that was rolling higher and higher. And we've got it to a point now where, weekly active user almost equals daily active user, which is pretty impressive. Or I should say daily active user almost equals weekly active user. But the other one that is really important for us is the hours that would be spent in product per day. So the average user was in Dooley between 2.5 and 5 hours a day.
Wow.
Which led us to the clear observation that people were spending more time in us than they were in Slack. That's pretty epic.
And that
was really a big moment for us.
And that, I think that is probably one of the biggest indicators that this thing can be huge, because salespeople, for the most, hate Salesforce. They don't like working in the Salesforce. And this is me interviewing thousands of salespeople for my previous company.
Yeah, you lived it.
I lived it, right? And when you have sales reps spending 5 hours a day in your product, that means they're getting value.
Yeah.
And they're getting outcomes.
And equally, and this is the cooler part, as you start to dig in, you got to do a lot of user research to understand all this stuff. But what we also noticed is that people were saving between 5 and 15 hours a week in terms of time. So they're spending more time on our product, and it's not coming at the expense of like just having to do more in general. It was actually reducing their workload. We have this thing internally, part of our value system internally is baked in with this idea of this 501 promise, which is, from 9 to 5, your company has you, right? And that they've got you, that you got to work. That's what you signed up for. 501 rolls around, you can choose to work, but you shouldn't have to, right? And so our goal is to make it so that 501 onward, that's your time. Your weekends are your weekends. So I always joke when I talk to investors, when I talk to, senior leaders, if the ghost of Christmas past went to somebody's house on the weekend and the ghost of Christmas present went to somebody's house on a weekend and saw a salesperson inside doing CRM updates while their kids were outside playing or tugging at their shirt, trying to get their parents' attention, you'd feel like a pretty bad boss, right? And
yeah.
Equally, that same boss, when the person was in the office, they would look over their shoulder and see people working on, doing their Salesforce updates and things that were like low value selling activities. And they'd be like, what are you doing? This is like prime time. Come on, get out there and sell, right? So there's this conflict that's been created, and we just try to eliminate that by focusing on that 501 promise.
Definitely. And there's a couple of things that I heard there. One is falling in love with your customer and constantly making them successful. And you talked about how you're constantly adding new things. What happens often is people fall in love with the solution and then they just get stuck there. And we've all seen yesterday's sort of wow features become like today's performance and tomorrow's table stakes. But if you fall in love with the customer, you're constantly helping them get to that outcome and even improve that outcome. So that's phenomenal. Now, you raised these 3 rounds, $102 million, all in a span of 6 months. Tell us a little bit about the timing and why did you choose to call that first round seed round?
Yeah, so we had raised like an angel round in 2018, and we were pretty capital efficient with it, and we're moving along quite nicely. Then the pandemic hit, and we were planning on raising. I was actually supposed to be down, for SaaStr in March of 2020, and you get the email from Jason Lemkin saying, "Hey, FYI, cancel your plane ticket. It's done." And he was pretty confident, like right up to the last minute, that it was going to go forward. And then, of course, the world really had a hard right turn. So that really messed with our plans for fundraising. We knew that we were at the point where we wanted to start scaling different parts of the business. We knew we were at the point where, bringing on more funding was going to be important for us to stay ahead of our imminent competition that would eventually arise, all of those different things. So I would say the first part of 2020 was really scary from a business perspective. When you have these objectives you're trying to accomplish and the market basically pancakes on itself. So you've got VCs that are shoring up their existing portfolios. You have some VCs not spending at all. So now there's like less supply and more demand on that supply. And so you start trying to figure out like what's your narrative? What's your story? How is it going to evolve? How are you going to be different than everybody else? What we did in sort of June, July timeframe is radically change the way we were thinking about ourselves as a business. Because I don't see this as, notes that update Salesforce or a workbook that's for salespeople only. This is a much bigger story and a much bigger narrative. There's a lot of people that get stuck in low value work, and we can help them all. We're starting with revenue teams. And I've talked to hundreds of VCs, and some get you, and they understand part of the story, but they don't get the whole thing. Some have some people that are all in, but the way that they select new investments is by committee. And so we were always in this world of, revenue. The revenue space is busy and people aren't really super excited about it. Well, I mean, look at last week or this week with, Gong and Outreach's announcements of about 450 million in combined funding, with a combined valuation of about what, $12 billion. Revenue has become sexy again, thankfully. So I think we were a beneficiary of timing and finding the right people. We found a vein, and I always talk about this a little bit differently. So think of fundraising as like a big tub of butterscotch ice cream. For the most part, every single scoop is vanilla, and you didn't buy a tub of butterscotch ice cream for the vanilla, right? And so when you find somebody or a series of investors that are very aligned with your thinking and your philosophies, that's when you hit the first vein of butterscotch, and you're like, oh, that's what I wanted, right? And when you find the ones that are very, very aligned with you, that's where the intersection of all of the butterscotch veins at the bottom of the tub is, right? That big blob of butterscotch, that's where you want to hit. So we hit that in July with Box Group and Bold Start were really the two catalysts for a lot of the things that have gone on moving forward, where, thesis just beautifully aligned with where we were going. And I would say like we were this really weird, unknown Canadian company, maybe being a bit too humble, maybe not being assertive and vocal enough. And also, we were sort of a few years into our journey. So we wanted to figure out like a good way of amplifying our message. So we took the money, the funding from Bold Start and Box Group, and that became a bit of a trampoline for us, to be honest, because they worked their networks really well and just said, hey, FYI, we're really excited about this new investment, check it out. And so we closed that on September the 1st. My dad died 3 days after funding, which was a real punch in the gut for me. It was super unexpected. So, you're super elated, everything's going really well. And then like the worst event that you can imagine happens. And that was really challenging. So I unplugged. I told my investors, I'm like, sorry, I literally just took money from you, but I got to deal with something. Otherwise I am going to implode. And my dad had been battling pancreatic cancer for a few years. So I say it was unexpected, but like he was going through a journey. But the end was definitely not expected. So we unplugged as a family and kind of like corralled around each other and made sure we were all well looked after. But while that was happening, Ed from Bold Start was, telling some of his buddies about the investments that he just made, and Dooley kept coming up, and people were really interested. And of course, like one of the interesting things that was told to me by a former boss of mine was, you can never time a market, right? So we didn't time the pandemic. We didn't time our fundraising. We didn't time any of these things, but all of these things converged quite well for our particular business. And it led to a lot of interest in our category. Future of work is the big buzzword that you keep hearing now. And Dooley brought the future of work into the now of work. So suddenly we had like waves of investors that were lined up to meet with us, based on sort of the buzz that our investors had made, and B, just because of where we were and the timing where we were. that led to, some pent up demand. I got back from grieving my dad's passing, and I started taking meetings, and they were all just like, you're trying to build these long tail relationships with investors. You don't expect things to happen overnight. And in our case, the interest was so pronounced that we ended up getting multiple term sheets within 6 weeks of closing our seed round for our Series A. So we announced it in March, but really we closed it in late October, early November. And that was, I think, a big shock, because again, we were reasonably well capitalized, and thinking that we were just going to soldier forward with what we had raised. And all of a sudden we had a preemptive Series A. It wasn't us going out and running a process by any stretch of the imagination. And so we announced that on March the 3rd, and it just triggered another wave of craziness. So you have a number of things that happen when you raise. First of all, everybody's trying to sell you something, right? Recruiters, technology companies, outsourced sales development companies. Those things hit your inbox like you wouldn't believe. But also the investor community was reaching out like, hey, sorry, we missed out on the A, let's build a relationship and start thinking about like what we can do for the B. And I just said, look, I'm not interested in having conversations right now, because we just raised back-to-back rounds and we're doing quite well as a business. But if you're interested in having a conversation around a preempt, I'm happy to have that conversation. And so that led to another wave and another series of like tier one, and the Series A, it was all tier one companies. The Series B was tier one companies to the nth degree. Another wave of investors looking, going, we want in. So, you get to do things a little bit more on your own terms. And the reason why we were amenable to it is because the terms were very much focused on what we needed as a business. We have a roadmap that we can draw in now. We had plans for more money than even what we took on. So look, it's been quite a journey. This helps us to accelerate our roadmap pretty tremendously. So the reason for taking it's pretty clear. And again, just an opportunity to work with some amazing investor partners.
Fantastic journey there, and thanks for summarizing that. So I caught a few themes there. One is the market timing, right?
Yep.
Salespeople all working from home, and if you ask companies what was the biggest accelerant of digital transformation in your company, they would say COVID-19.
Totally, 100%. All these people that were asking you, can I work from home? You're like, no, we want to work in an office. And all of a sudden, like, I have to work from home. There's a pandemic, and you're like, okay. And then we're all like, oh, this actually worked out pretty good.
Exactly. And then you got with that, the interest rates falling down. So now you got hedge funds and everyone sort of saying, hey, if I'm getting 3% interest on my capital, I'm going to invest in VC. So the market's heating up, right? And you had some good early investors who believed in you at the seed round, post angel, and they warmed up the market for you. How did you meet your first investors? Because it seems like a lot of trickle down effect from Bolstart and them. Like, how did you meet them? What made them buy into your vision?
Yeah. So one thing I want to say to everybody that's on this call is you have the right to select who's coming into your cap table. And it should be as much an honor for them to join your cap table as it should be for you to have them join your cap table. And a lot of people don't think like that. A lot of people think, I need money, therefore I'll take money from these people and I'm now beholden to them. And yeah, of course you have a responsibility to your investors, and I don't want to diminish that at all. But what we did, which I think was really good, is what I always do in sales, which is what and who else. Okay, what can you bring to the table? Who else should we bring onto the cap table? Right. So when we were talking with Ed and with Box Group, they're always like, yeah, we think that you should have this person, or you might want to meet this other person. They would be super helpful for you in this round. So I started to track things really differently than I had previously. And I started asking people up front, like, what are your superpowers? And I was looking for not only their superpowers, but what they were willing to commit to relative to the size of their check. Like, if somebody writes you a $5,000 check, don't expect them to do $5 million worth of work, right? Although it might benefit them tremendously, to be honest. And so we would dig in on the superpowers, and there were really four things that I was looking for almost every single investor that was coming on board: access to capital, access to talent, access to customers, and access to operational smarts in our discipline. And then there's some intangibles as well. Like I have the chain smokers on my cap table, which may seem like a really illogical thing to do, other than the fact that A, they're fucking smart people, and B, from a retention perspective and a talent acquisition perspective, it's pretty cool to know that when the chain smokers come to Vancouver, when the pandemic is over, or when we all go to Vegas, then we can go and have like a VIP experience with the chain smokers with the team. Kind of cool, right? But yeah, I look at those four superpowers of capital, talent, customer, and operational smarts, and then I scorecard my investors against that, and it's almost like they're signing up for a commit on their forecast for the year of what they're going to do. And then when it comes to like future rounds of funding, not everybody has pro rata rights in your funding rounds, and I use it as a vehicle to say, you know what, you don't have pro rata rights in this round, but you did some pretty damn good things with for the business over the last 3 months. I'd really like to extend you the ability to re-up if you want to. So it's almost like they're getting their Christmas bonus. And you're showing like this two-way street of, building a great relationship and building a high-performing cap table. So like we have Xander Lurie, the CEO of SurveyMonkey, on our cap table. We have the former CEO of Atlassian on our cap table. We have CFO of Menlo Securities. And again, I look at like, have we diversified ourselves on the cap table so that we have like the ability to have reach in all of those different disciplines?
Definitely. And then the Box Group and Boldstart, you met like through the network, you cold emailed them. How did that start?
Yeah, I mean, conversation leads to a conversation leads to a conversation is usually how it happens. And a lot of this happens, and so this is another reason why exceptional customer support and exceptional, user experiences is important. Somebody told Box Group about us, one of our customers. They're like, you got to check out Dooley. This is an amazing company. And so, yeah, they had already known about us when we connected with them because somebody else had said something really good about us.
And nothing is better than customers saying, my sales team spends 5 hours a day in this product and it's driving our revenue.
Yep.
I don't think anyone can say that, right? Like how many companies can say that? Salesforce can't say that, right? And so that is very, very powerful. How did you manage the dilution discussion with the earlier stage investors, your angels and whatnot? What did that look like?
I don't think that there was any pushback whatsoever on that. In fact, most of them recognized the importance of bringing on people that had reach beyond, like most of our angel investors were from the local community, right? Most of them realized that their money was going to perform better if other people came on to the cap table that had more reach, more influence than themselves. So they were more than happy to back away from that conversation entirely, to be honest.
And there's two things I want to point out here. Like I've seen Kris, like his early days of hustling, going to every relevant conference and event and connecting with everyone. He's a super connector. He gives before he gets, and
Lloyd's a super connector. I'm like a notch down from Lloyd.
You're being too kind. But Kris was just everywhere. And then the second thing is the focus on relationships. Oftentimes founders optimize for the transaction. Like they treat this investment process like, oh, let me run a 3-month or 2-month or 60-day or 30-day process. And then when you optimize for the transaction, the first time that a calamity hits, your investors are out of there or you're out of there. So you've focused a lot on the relationship and talked about like what value they can add to you and basically that their buy-in to your vision. So those two things, like hustling early on and finding strong relationships who really care for you as a founder and your business, I think those are key.
Yeah.
How do you mitigate the fear that you raise too high a valuation to grow into possibly?
Well, so I often joke that, we were a quote unquote seed stage company that took on Series B money, which is kind of like giving a toddler Shaquille O'Neal suit and saying, you'll grow into this eventually. So how do you mitigate that fear? You do things that keep you in alignment with your investors. So like I communicate with my investors every single day. That's one of my core responsibilities as a business. When
you say you communicate with them every day, meaning like you email them, you call them, you text them, like what do you communicate with them about?
it could be the littlest thing or the biggest thing, right? So what I don't want to do is make people feel like they join the cap table and I'm ignoring them, because that's them, joining a company that is a poor communicator. That's just not on, right? You need to help people understand what's going on with their investment. But equally, like, again, I know what all their superpowers are. So when I'm running into problems in certain areas of the business, or when I have questions, or when I need to find, a new designer or a new engineer or a new this or a new that, I know who to reach out to because my scorecard tells me, right? And my superpowers table tells me. So I'll just ping people with little bits of information here or there, which helps to mitigate your requirements of doing like these big formal grandiose things all the time. So micro communication is how we all love to work anyway. We know that because everybody uses Slack. And so I try to micro communicate with my investors over periods of time.
And one thing you outlined there, the job of a leader is to clearly articulate the vision consistently, right? All the time. And doing it to inspire, excite, and entertain and motivate people. If you're doing it just to inform, then you may as well like write a memo kind of thing. And you've done a great job of that. So William asks here, what does the scorecard look like for those capital, talent, customer, and operational smart dimensions? Have you found a way, like how do you basically weight one over the other? How do you score things?
So I look at what they signed up for, and I look at like I use Dooley for a lot of it, to be honest. And so, I have notes on all my different investors, and I keep notes on all of my different investors in Dooley, connected back to Salesforce, my own sort of private instance of Salesforce for my investors. And I look at what they signed up for, and then I say, okay, how much did they deliver relative to what they just signed up for? And so it could be like, again, somebody who puts in a $5,000 check or a $10,000 check, I'm not expecting a ton out of them, but if they're doing introductions for, talent, like they said they would, tick, 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 right? And then you weight that against, like, again, how big their investment was to see if they have brought you the value that you expected to get out of them. I don't have any specific like weighting that I do on it. It is still a little bit of, feel for a number of these things, but I have it all in a G sheet as well. So everything exports to a G sheet so I can look at it and make my assertions as I need to.
Saeed, great process. And one of the key things you've outlined there is focus on the relationship, but make sure you're running a process. Like everything is sales ultimately, right? Pitching investors, employees, press, like you need to have a cadence, right? It's not like sort of a one and done activity. You got to do this day in, day out, micro communication, build the relationship, and then they move. Like I hate using the word funnel because relationships are not a funnel, but ultimately, if you keep giving and communicating to excite and inspire people over and over again, then that relationship builds. So that tied to that, Saeed asks here, are investors even interested in your business, or are they just looking for an exit opportunity? I mean, everyone wants to make money, but
well, I mean, we're all in business for different reasons, right? So I would say that that's probably a question to ask your investors, like what's in this for you? Now they have a responsibility too. They've got a bunch of LPs in their funds, and they need to show returns, but they also are making a number of different binary bets, right? They're looking for like one or two that are going to return the entire fund, and they're making dozens, if not hundreds of bets. So I think that they're looking for areas where they think that there's an opportunity in the market, for sure, an area that they have domain expertise or at least interest that they've been pursuing, and particularly if you find the right ones. And when you find those ones, it'll be pretty obvious. Like Spark Capital, before we even sat down to meet with them, they had done a massive round of diligence on us. They presented us with a 20-page diligence doc, right? They knew what they were getting into before we even like had any discussions about, whether we were raising.
And that creates such a good vibe going in. Like that's what Radiant massive trust, right? Like they understand the space and they're telling you the gaps and how you can fix it. And that's what Radiant did for us. Like we weren't even raising and they came to us with this thesis and we're like, it makes it natural. Yeah. David asks here, funding rounds, particularly early ones, are driven by metrics or story. So given the short span of time between seed, Series A, B, is it safe to say that sort of these folks were all tied to the narrative and the market timing versus like revenue numbers, maybe?
So yeah, I would think that that's probably a fair assumption for us, is that, you know, the vision played a large role in it. Like we're growing all through this as well. And I would say, you know, the scaling was only accelerating to the point where, you know, we did as many signups in March as we did all of last year, right? So certainly there was an acceleration component. But they also understood that they were dealing with a group of people who really understood the problem, who really understood how big the problem truly is, and also had a pretty interesting and compelling story about how to get that thing solved. And so, yeah, I would say narrative is probably a safe bet as to, you know, what made them believe that we were bigger than we are.
And that's a good point, right? So let's anchor in here. Like a lot of people think that they have to end up with the company they started out with, but Facebook didn't end up that way, and neither did Google, right? Like if you fall in love with the customer, then that vision gets bigger and bigger. Or rather, you can grow into a big vision. If you fall in love with your solution, then you're stuck there. And you know, with I see that duly replacing Evernote. I see it proliferating in a company beyond just the sales reps, because the sales rep is a connective tissue in a way, right? Like they inform, they communicate with product leaders, the sales leaders, they communicate with marketing, they communicate with customers, they communicate with customer success. How do you see this playing out, or do you go beyond sales?
Quick answer to that is more than likely. So the way that I'll explain this is everybody wants to own data. Data is the new oil or the old oil. Well, guess what? The world is moving to electric vehicles. So oil is a dying breed. And so it's not data that's important anymore, it's workflows and efficiency. And so we have really looked at the way that people tried to build their business. And the reality is everybody's a data silo. Evernote, data silo. Salesforce, data silo. Outreach, data silos. There are all these data silos that are building around the business. And we're like, why fight with all the data silos that are out there? People don't want more. They want the data silos to actually be well curated with better information, more comprehensive information, and more current information than they've had in the past. So we decided to become something that is like a version of Evernote combined with a Rubik's Cube, if you will, and combined with a zoom lens. And so it's almost like Zapier where you do your work, but the idea behind what we do is we're breaking old paradigms and just chopping away at all of these really terrible workflows that cause context switching. The best parallel I can give you, Lloyd, is in the 90s and in the early 2000s, we had servers around the organization still. And we had like a terabyte of storage hanging off of one server and a half a terabyte hanging off of another. And then somebody's like, but I want to see it as 1.5 terabytes. So they created Fabric, right? And it was this thing that allowed you to virtualize your storage. And now we have apps that are hanging off of the whole organization. There are apps everywhere. And now we're at the point where people are like, I want to virtualize my apps. I want to like create one sort of fabric between all of them that allows me to broker between all these different things. That's what we're doing.
Definitely. I see this as the connective tissue of organizations around the world,
Yep.
right? That's the narrative, because it starts proliferating. Are you seeing sort of other teams starting to pick up, like it's seeping into CS, it's seeping into marketing?
Yeah, absolutely. And you know, it's the same thing that happened with Slack back in the early days. They had, you know, product managers were their wheelhouse. They knew that was the right part of the organization to go after. We knew AEs were the right part of the organization. And if you were to take a subset of that, like solutions engineers are gold for us. And so we started to build off of that, and you'll see like more and more feature functionality coming out that allows for other people around the organization to reap benefit from having duly implemented.
Definitely. And I see that vision of being the connective tissue across organizations, starting with the salesperson and proliferating, that's a massive vision, and probably tied a lot to those successive raises in addition. Combined.
Sure. You know, there's a lot of stored energy. There's a lot of potential right now for what we're doing.
Awesome. I want to dive into valuations a little bit. Like you've raised, like,
Mhm.
how do you think about valuations when you're raising in this market? Like, what are the metrics? And I want to outline that metrics doesn't necessarily always mean revenue. It could be whatever metrics you deem, and it could be users tied to your big vision, right? Like,
Yeah.
am I saying that right? Like, how do you think about valuation? I think you disclosed the valuation in the TechCrunch article, or maybe they speculated,
Yeah,
but it was
they
pretty
speculate.
high.
They're a little low, but that's fine. We'll take it. Frankly, I I think that valuation is something that is just it's a mutually agreed upon exercise, right? If you show somebody a real linear path to the finish line of what you're doing 3 years out, they're going to be able to draw a conclusion of what your valuation is going to be, right? And when you have people that are preempting, they need to get a little bit more comfortable with ambiguity in terms of like I would say your traditional SaaS metrics, right? Like MRR and all that stuff. Well, relative to a Series B, MRR is probably not where they wanted it to be, and all the rest of that stuff. I was very forthright with that. But we started to dig in on virality because our K coefficient is like our North Star metric, and we started to talk through again more like hours spent in app and net promoter score and net rev retention and some of the other things that were clearly indicating that we were performing quite well at our stage. And as they dug into those, it was pretty clear that we had something that was pretty special.
And if you
So
look,
they kind of it was like they paid a premium relative to where we are, almost like a speculator's tax, for where they know we're going.
definitely. And if you look at Slack in the early days, it was mostly free, right? For a long time, it was mostly
Yeah,
free. But it was proliferating organizations, and that's what people are seeing, this becoming the connective tissue across organizations
yeah.
in a similar way. That's awesome. And so, I think there's a key lesson here is a lot of people anchor on different types of things. Anchor on one thing, find your North Star metric. If that North Star metric is virality and it is serving the bigger vision, that's
Yeah.
probably more important than trying to show some other metric that you think aligns with the
And so
investor.
many of them, Lloyd, so many people put vanity metrics up because it makes them feel good, and it's just garbage. There are days when we look at our K coefficient, we're like, it's not good enough, and that it should feel uncomfortable, right? Because you're not doing all the right things. So then you go in and you try to figure out like what are the OKRs we're going to put in place to improve on our K coefficient, and to get our user count cranking even more. And I think that if you want a good lesson that I learned from one of our earliest investors, it's have three different metrics in place for the business when you're sort of starting to see scale. First metric is one for demonstrating shareholder value, right? So that is probably something like an MRR metric in SaaS or ARR or something along those lines, or it could be just like raw users if you're a free product. Have another metric that is around employee satisfaction, right? Something that shows that you're drawing in great talent and that they want to stay. And then your third metric should be around customers. And that's probably like an NPS score, or it could be, again, total hours spent in product or something along those lines. But find a metric in each of those categories so that you can clearly walk around the organization and go, okay, here's where we're at with our customer satisfaction. Here's where we're at with our shareholder satisfaction. Here's where we're at with our employee satisfaction. You know those three things and you stay true to those three things, you'll have a good performing business.
Definitely. And in terms of what's next for you, and how did you sort of frame this, right? Because you raised seed, Series A, B, 6 months. You probably didn't imagine you were going to build the team you did at seed that then you said, okay, I'm going to build at Series A, and then now you probably did plans evolve in 6 months? Like, walk us through that.
I think that just plans accelerated, right? Again, so the way we run our business is we have a 3-year goal always in mind. It's 3-year highly achievable goal, and we break that down by month and by quarter. And again, we build our OKRs around that, so that we are all, again, moving with discipline and hustle and focus toward that finish line. But it's a floating point. Like the 3 years, you never hit 3 years because 3 years shifts by 1 month every single month, right?
Yeah.
So we built our whole business model around that. And what we realized is that by taking on more money, we could take in year two into year one. We could absorb it, right? We just accelerate roadmap because we're a product-led company. So like 80% of the stuff that we do is product, right? And making the product more attractive and improving time to value and improving, the connectivity of it to the things that matter, and just like hacking workflows for people. You build those things out for people faster, and you're only going to improve your K coefficient. So that's, for us, it was an easy discussion to have with the investors around what we were doing, because again, it's all about like accelerating product roadmap.
Definitely. And it's hard to do this though, right? Like have this sort of 3 years, because but if you do, then you know what money is going to accelerate that. A lot of people just think like for the next quarter or for the month or for the end of the year. If you think through the big vision, then you can map out how much money you need, and what would infinite money or any amount of resources do that. Knowing what you know now, what are some major resources you would tap into giving you better results in raising capital?
I would have been, and this is no slight on my earliest investors, I would have been far more meticulous, I guess, with who I brought on my cap table, and I would have asked more of them. I think that at the beginning you're like, again, we're not worthy. Total Wayne's World moment, right? And once you realize that it's a mutual relationship, it changes the way that you work. It changes the way that you operate. I think of them as an extension of our business. Most of them would show up as like dually employees, or those that are more comfortable being in the limelight. And so yeah, we would definitely lean heavier on that. In terms of other things that I would do, I would spend more time doing the Steve Plank stuff, right? Which is get out and talk to customers even more, right? You cannot underscore enough how important it is to really dig into the pain, and would they pay to have that pain go away.
I want to take some audience questions here. Terry asks, are the founders still in the cap table? How much dilution occurred to Series B? I think what I heard there is you guys didn't need to raise the money, but it was preempted. So you mostly raised on your own terms. And so across basically customer satisfaction, employee satisfaction, trifecta of shareholder satisfaction, and you raise on your own terms.
Yeah. Look, are we still on the cap table? Yes, we're still on the cap table. And we're doing just fine on the cap table. So, we have investors. Like, what your investors don't want, if you get the right investors, they actually don't want you to become an employee. They don't want you to see this as a job, because that's when a founder who is naturally an inventor, or somebody who likes to build things from the ground up, that's when a founder starts to get itchy feet and want to find their next thing, right? They don't want that. They want you around. They bought into you, so they're not going to try to dilute founders. It's just not in their best interest.
I think a lot of these questions come from a place of bad stories or negative stories out there. And I think one of the key advice for founders is to understand the investor's motivation. If you're chasing investors who want every investment to return the fund, that's okay. But just remember that you got to run according to that hyper growth principle. If you're chasing investors who sort of want to make 2-3x versus 100x, then you'll move according to that principle. Your investors and who you pick as partners, I would say more than investors, dictate the strategy of the company in some ways. Yeah. Is that not it?
One thing I will say is listen very, very carefully to how an investor answers this question. So if they ask you how much you're raising, you give them a number. And by the way, I don't recommend giving them a number. But let's say you do give them a number. If they say, why so much, you have the wrong investor. Right away, I promise you, 100 times out of 100, you have the wrong investor, because they're trying to minimize dilution. If they ask you a different question, which is, what would you do with more? Then you might have the right investor, because that person understands that they can help you accelerate, and they're not as worried about their dilution, because they can probably do follow-on funding.
Definitely. No, this is actually a great question. So ask, so throw a number and watch and just, I
Yeah,
guess, shut
see
up.
how they react to it, and you'll get a really good sense. Now, if they're a number that's too low, they're going to think you're unambitious, right? If they're a number that's too high, yeah, they're going to think you're not realistic. And but equally, they'll think you have more swagger. I would rather throw a high number than a low number any day of the week.
Yeah. There's a lot of questions around revenue, and I think like probably irrelevant here because the key North Star metric was virality and product-led growth. And I want to point out here, if you look at the most successful companies of the last decade, the fastest growing companies of the last decade, all the unicorns that are performing better than others on the SaaS companies that are performing better than others
Oh
on
yeah,
the stock market, they're all product led. Like look at Dropbox, look at Slack. They all started in that
Leo,
product. Yeah, clear
they're
on
killing
that
it.
product led model, and maybe early on it's a different North Star metric than revenue. If you're looking for standard North Star metrics, then you can right now in this market you can go and raise a seed round with not much revenue. You can raise an A with 1 to 3 million in revenue, and you can raise a B with like 5 to 7 million in revenue if that's the metric you're chasing. But I think Kris is talking about something much more bigger here in terms of being the connective tissue of organizations around the world. And you got this virality metric and hours spent in product, the whole product led model, right?
Yeah, yeah. Look, if you think about it, it makes a lot of sense why PLG is accelerating. So we have decentralized from a CIO and like having like an IT shop within most organizations. It's more of like a marginalized part of the business now with a different set of responsibilities. And so you have decentralized decision making on tech stack, right? And you have people that are managing those tech stacks internally. So let's say you're the operations team, the sales operations team at a company, uh, and you're managing Salesforce almost full time. There's no way in God's green earth you're able to like investigate and find new technologies faster than your team can find them and bring them to you. And so people have realized that the user has way more power and leverage in the conversation than they ever did. And so now it's all about solving end user pain and getting them to buy in and promote differently. So for us, like that PLG model makes perfect sense. It's just,
Definitely.
again, you can't time a market. 4 years ago, it didn't make as much sense. Now it is.
Definitely, makes sense. And folks, look into product led. OpenView has a lot of OpenView Ventures has a lot of content around product led, but just
Yep.
Google YouTube for product led. I think it's the way of the future. And basically, customers get the value first, and they pay you, and you start proliferating within an organization is just brilliant. How much did you tell your early investors when you were raising how much money you were raising, and what was the reaction?
Oh, I mean, elation, really. Everybody's just really excited. What you realize is that a lot of your investors are also your cheering squad. They want to see you succeed, and not necessarily. Somebody asked a question about like, do you have to repay investors, and what if you don't show profits? Well, if I don't show profits, I'm probably going to get fired at some point in time. But most SaaS companies aren't profitable because they're continually pouring the revenue back into the business and try to create further acceleration. At some point in time when you want to IPO or you want to get acquired, then maybe those things become more important. But yeah, look, your earliest investors, they're realizing that they're investing in something that's super high risk. Again, it's a binary outcome for them. You're either going to succeed or you're not. There's very few companies that they'll invest in that kind of like just plod along.
They
It's
don't
like,
want to. There's different types of investor for that,
yeah,
probably private
yeah,
equity,
yeah,
sort of thing. Now, question here tied to this, right? So product-led growth, K factor, meaning virality and
yeah.
product usage drove this. But how much was IP or TAM a part of that discussion, or did it matter, or did it not matter?
I think that TAM certainly plays into it. I mean, they do their homework. They're not idiots. I mean, investors, particularly when you're writing big checks, they're really knowledgeable in the markets that you play in, and they're speculating a little bit, but it's a very educated guess. It's the difference between the person that actually knows why they bought GameStop and the person that is like speculating that it's going to wildly go up or down based on I heard some noise, right? they're some people are going to make money on both the up and the down on GameStop by comparison, because they know when to get in and when to get out. They know the moves, and some people are going to get hammered. You want to get
Definitely.
with the right people.
And one question, I think the IP gets thrown out a lot, and I feel like a lot of sort of non-sophisticated investors or people, founders who don't know the market, they ask this a lot. I think IP used to be the old moat. Today, the moat is different. It's like, what do you have that system of intelligence? How are you building an ecosystem? Do you have network effects within your product? That is the moat and IP today. That is what you have, right? Like you're growing virality. You're building an ecosystem within, and you have a system of intelligence based on gathering all this data, isn't it?
Yeah. Yeah. So I just want to say, like, your moat is never one thing. And if you think it's one thing, you're going to get killed. Your moat is always like 5 things, or 3 to 7 things at best, right? So our moat is based on a number of different points that anybody can rip off one of those things, but to try to figure out all 5 things, it's like trying to reverse engineer KFC's secret spices and herbs, right? I mean, it's public now, but you get the point.
So if you had to prioritize, what would they be?
If I had to prioritize the things in ours,
yeah.
Oh, again, it's kind of our secret sauce, but I would
or general advice, I guess, general advice without giving away the secret sauce.
Yeah, for a product-led company, you're probably going to create moats that are around, how you create a network effect, per what you said. You're probably going to create a moat around information, either the owning of it or the distribution of it. You're probably going to create a moat around your user base, and like in our case, our fanatical user base. That is it would be really, really hard for somebody to come in and like talk to one of my users and go, hey, we're at company X and we think that our product's better than theirs. You should switch. And our users would be like, get the hell out of here. I'm a Dooligan. Like, they get it, right? Like they're part of something that's bigger. We've had their back and we'll continue to, and they have ours. And then there's probably some other things. Again, I always think that inextricability is a really important one, right? So, the harder it is to remove, and I'll speak to my dad's case, the harder it is to remove a tumor, the more likely it is that the tumor is going to stick. And I don't want to consider our platform a tumor by any stretch of the imagination, but same sort of principles apply. The more stuck in it is, the harder it is for you to take something out. And I think Colin just mentioned something about building community, and I think of community and movement as almost interchangeable components. So yeah,
the way I see it is this: when you have a mission and you got your company excited about it, it's a mission. And when you got your customers excited about it, you build a community. But if you got everyone excited about it, it becomes a movement, and that's what what you guys are doing.
Yeah, I always say, like, this isn't our mission. This is our users' mission. Like, we're helping them solve the things that they know they wanted solved. We just get to be the person that carries the torch. And I carry it on the backs of some other companies that were here before us, like the speakeasies of the world that were close, but timing was a little bit off, right? And so you have to pay respect to your elders and those that went before you. And when we raised our Series B, I actually reached out to some of the companies that didn't quite make it, like the people, the founders, and just said, just so you know, your initials are engraved in the torch that I carry.
That's awesome. That's a fantastic, noble way to look at it. You're growing. How many people are you guys at right now, Dooley?
38, I believe.
Wow, 38. I thought you'd be much bigger with all this this money. But as you're growing as a founder,
it's time to hire.
Yeah, you gotta hire. We hired 50 people in the last 3 months, and I'm going crazy. Yeah. But my burning question to you is this: as a founder, as you grow and add more and more smart people, how do you ensure that the vision and the strategy and the values are ingrained when you're not in the room? How do you ensure that the team is aligned with your vision, your strategy, your goals when you're not in the room?
So I think that one of the questions you wanted to ask me later was like good books to read The Speed of Trust. Like that will give you a sense of what's helpful for you in terms of like understanding that you can scale things. we have a very trustworthy and amazing executive within our company, which I think we just did a press release today about some of our most recent executive hires: Candice Bashgorich, Nikita Miller, Michelle Peach, and Gigi Wong. So 4 amazing woman leaders that we brought into the business, which, by the way, I told my grandmother, my 94-year-old grandmother, she's like, so do you have any women working in the business? I'm like, Grandma, more than 50% of my company is women. And she's like, oh, that is so wonderful. And, you think about somebody that got stuck, like never being able to go beyond bookkeeper back in her generation because of her gender or whatever biases were, against her. And I was just like, it actually made me cry. Like, I was thinking, oh my God, like you probably should have been the CFO of the hotel that you worked at, and instead you got stuck. And it really was heartbreaking. But equally, I was really proud of that. But those people that we brought into the business are now the ambassadors of your values that you create together. They are the ambassador of what you want to do to execute across the business. And we meet weekly, if not daily, to talk through execution so that we don't do things that are out of phase with one another. As a team, we're going through Scaling Up, which is another great book by Vern Harnish, and really cementing our process for the next 3 years running.
And so the book recommendations were Speed of Trust and Scaling Up. I think what I saw that I heard there was hire smart people who
hire amazing talent. Like, hire people that are way better than you. They're all way better than me.
And that's what I say. Hire people who are smarter than you. Get out of their way. You hire them so they tell you what to do versus the other way. And
don't zigzag. I worked for a company before this that zigzagged a lot, and they could have been Qualtrics, and instead they're kind of like, I mean, they're doing okay, but they're nowhere near what Qualtrics became.
Define zigzagging.
Making decisions based on shiny objects that take you off the path, right? If you agree to a 3-year plan, focus on a 3-year plan. It's okay to adjust according to like changes in the wind. Like, obviously the pandemic was a massive change in the wind, right? That changes the way that you operate. But for the most part, you need to stay really true to like give things a chance to actually be seen through. We used to constantly be like, oh, well, this customer asked for this thing, so let's like stop engineering on this side, or building out reporting for our last platform, and let's build this other thing that was completely irrelevant to most of us because somebody was willing to write a small check or maybe a big check for that one-off thing. Disaster, right? Now you're months behind on roadmap.
You don't build a movement by doing one-off things for many people. You can build a big company though if the same kind of customer falls in love with you to get that value coming through one channel over and over again. And you've just nailed it, man. Kris, any parting advice for us?
So my parting advice would be stay true to your customers, stay true to your process. And if you're fundraise with a bit of swagger. Don't feel like you're kind of like groveling for funds. It comes through. And equally, like when you're running a process, run a process that you feel comfortable with. You have to be your authentic self, right? So like this is going to come across different, but like I never ever presented a deck, not once, not on any of our funding calls, never once, because it wasn't who I was. That doesn't mean you shouldn't. It just means that if you do, own it. Like make it so it is you. Make it so that the words are yours, not some rehearsed kitschy thing, because they see hundreds of people present every single day across most of these VCs, or every single week at least. And they tune you out within minutes if they think that you're like being like everybody else. I promise you this, every single deck has that same curve, right? It's like, oh, look, we're going to grow this much in the next 3 years. Every single one has that, right? They know their bullshit raters are on full alert when that slide comes up. They want to understand that you understand how to get there.
Exactly.
You've got the vision.
And that you couldn't have said it better. We didn't use a deck either. It's not natural to me personally. I think you're focused on building relationships, and that's what connected us too. And if you focus on building the relationships, and you can paint the 3-year vision with numbers and a great story, you'll build stronger relationships and buy-in than showing things on this contrived deck. Awesome, Kris. Thanks for joining us. It was super informative. We're a little at the top of the hour here. Where can people find you? Dooley.ai. Check it out. Try
look
it.
at my name in the bottom part of the panel there, https://start.dooley.ai. If you are using Salesforce today and you're not using Dooley, you're probably incurring more work than you should. So if anybody wants to reach out to me, you can also reach out to me via email at kris@dooley.ai. I'm happy to field questions. I think there's something else that's really important, which is just paying it forward. So I'm happy to pay it forward if I have capacity. Obviously, I'm really in crazy execution mode right now.
You've always done it. And I love you guys' blog, dooley.ai/resources, /blog
Fire
dash
Talks
post.
is more fun. Fire Talks is more fun. That was something that I started last year during the pandemic, actually, which is like eating spicy hot wings while interviewing guests. And I did like 2 episodes of it and I was like ill. So I parlayed that over to my head of marketing, who seems to have a stronger tolerance for it. And Fire Talks is just a great way to absorb content because it's far more entertaining than your standard. I mean, Lloyd and I are great people and all, but seeing us eating hot wings would be far more entertaining for you.
You know what? I'm gonna ping him to get on it because I love hot wings.
Oh boy,
that would be fun.
You're asking for trouble. We've found some stuff that's really like it's beyond police grade pepper spray.
I come from an Indian background. We eat hot stuff all the time. Let's see if the wings last or I last. Awesome,
I
Kris.
come from a Scandinavian background where black pepper is spicy, so I'm at the exact opposite end of that spectrum.
Awesome, Kris. This has been fantastic. Wishing you great success. Stay in touch.